Good morning and good afternoon. It is great to see so many of you joining us for this town hall on the SPAC Revolution, very kindly sponsored by Pillsbury Winthrop Shaw Pittman. It seems only fitting that we should be discussing futuristic vehicles on May the 4th or Star Wars Day. Special purpose acquisition companies, or SPACs, have been one of the hottest vehicles in the finance world for the past few months. In aviation, we have seen early stage or pre-revenue companies merging with SPACs to gain access to more capital and exposure. It has particularly been a popular route for eVTOL companies such as Blade, Joby Aviation, and Lilium. I'd now like to bring up an all-star panel of experts to discuss today's topic. We have Kirsten Bartok, Managing Partner at Air Finance and co-founder of the SPAC New Vista Acquisition Corp. Hi, Kirsten. We have Matt Osman, who leads Pillsbury's International Public Policy Practice, joining us today. Nick Fazioli, Global Head of Aerospace and Aviation at Jefferies. And finally, Robin Riddell, Partner at McKinsey & Company. Hi, guys. Thank you so much for joining us today. Really appreciate your time. So we're going to dive right in with why are SPACs so popular at the moment? If you'd like to take us through that, Robin, to begin with, please.
Yeah, thanks so much for hosting and having us. I mean, look, maybe we'll start with a simple chart that we put together, and even though it's only a few days old, it's already outdated. But if you could bring that up, it shows basically the funding that has gone into what we call the future of air mobility space. So that would be, basically eVTOL at the manned AM space, but also drones, sustainable aviation, even supersonic and hypersonic. And I can't quite see the chart, but what it would show us is that we've probably seen about $8 billion investment over the last, call it 10 or so years into the space, of which about 80% went into manned AM. And it really has been a revolution in the way of funding in the last, call it 18 months, where we've seen a massive influx. Here we go. Of funding, right? So the dark blue color here is the manned AM space, kind of what we call UAM or eVTOL space. And, just this year alone, in the first 3 months, outpaced any prior year in terms of public funding in space, so things that have been announced. And that is a result of the SPACs, right? We've had a number of large deals in this space that have injected hundreds of millions, if not billions, in some of these companies, the proceeds, assuming that these deals will close in the coming weeks and months. And that is a big change for this industry, and it gives us a chance to really scale it up. And why is this important? It's because it's a very capital-intensive industry with revenues quite a few years out. And so as a result, it wasn't necessarily easy to get venture funding. And this type of funding has allowed some of these companies to really make a commitment to bring vehicles to market and set up operations. So that's why we think it's very important, and we see this in the numbers here.
That's great. Thank you. Nick, do you want to weigh in on that?
Yeah, no, sure, happy to. Yeah, I mean, look, the SPAC market, just in general across all industries, has become such a significant portion of the, let's just say, broader IPO activity. A couple years ago, like 2018, it was roughly 20% of the issuance, and that was way up from any prior period. And this year to date, 2021, it's over 70% of the IPO activity is coming through the SPAC market. So this is not just an aviation, phenomenon, but a lot of the attributes of the types of companies that we're referencing here, it sets itself up well for the SPAC product, right? And that's why it has been, if you think about it from a company standpoint, right, the ability to access, very significant amounts of capital, both from the SPACs, cash and trust, and also from accessing the broader pipe market, which we could talk through as well. But basically, those two combined forms of capital are advancing, years and years of sequential, venture rounds and allowing companies to, at least, per their current projections, be fully funded and advance the activity. And so the benefits are clear from a company's side. And I think the reason that the SPAC market itself has been such a good vehicle for it, or vehicle that is amenable to companies that maybe traditionally wouldn't have gone traditional IPO, is frankly the structures are very investor friendly in many ways, meaning the ability to invest in a SPAC, which is effectively at the time a pool of capital without an identified target, but to have the ability to invest in that and back very significant kind of leading teams and principals in certain sectors like Kirsten has with New Vista, but then still have the ability to pick up warrants and incremental economics and ultimately have the ability to redeem your actual capital back plus interest once you see what the target is. And so structurally versus a traditional IPO, the investors are incentivized to participate in the market, and then companies benefit from that. And that's really what it gets down to. It's a different set of rules than with the IPO.
Do you quickly just want to define the pipe for those that don't know the pipe in the SPAC deal?
Yeah. So the way it works is that if you take a SPAC that goes, so what technically goes public is the SPAC itself, right? And so they'll go raise, say, 200 million, 300 million into a trust, and it begins trading just as a SPAC. So effectively, all that is a pool of cash that has rights to redeem your money back up until the shareholder vote, and that is what actually starts to trade. What happens is when the SPAC principals find a target that they would like to have, oftentimes the need for capital in the deal, whether that is to compensate selling shareholders or just more likely put money on the balance sheet for growth, usually exceeds the value of the SPAC itself. And so what you do is you go tap what is the pipe market, which is in effect the same capital more or less that you would go to in an IPO. So let's just say third-party investors who are not invested in the SPAC. And the difference is those investors in the pipe market are actually presented with the deal, not just the SPAC. So if you're investing in the SPAC IPO, you're backing the team, the end market, the concept, whatever it is that they've sort of marketed themselves at. The pipe investors are actually being presented with an opportunity saying, hey, XYZ SPAC has identified XYZ target. We are merging. Here's the deal. Here's the terms. Here's a view on the company and its forecast. And then they have an ability to come in. So what's the benefit to a pipe investor is they're actually getting to invest in a specific transaction very similar to the IPO. And that's kind of the big rub here is actually, that is technically a merger. What is happening, right? What goes public is the pool of capital. The transaction that is in effect the company's IPO is technically a merger. And so they're allowed to see the deal and all the forecasts. So they get the benefit of seeing the deal and deciding if they'd like to invest. However, they do not get some of the incremental financial incentives that investors in the SPAC do, which come through warrants and, let's just say kind of incremental economics that they would get through that. So different types of investors. It's a lot of the same entities, in terms of the actual investors, but it is fundamentally a different point of investment and way to participate in the overall kind of ecosystem.
Mm-hmm. Kirsten, you've gone through this firsthand. Could you take us through the specifics of structuring the SPAC deal, please?
Well, structuring a SPAC deal, you start in the planning process of putting together a team. In the original kind of, we call it SPAC 1.0, SPAC 2.0, maybe 3.0. But in the early stage, it was a group of bankers who really had an understanding of how to take things public and would find out of favor assets to take public. In the recent revision of what a SPAC really works like, it is a combination of investment professionals, people who have venture and private equity experience, as well as operating executives, because you realize you need both sets of individuals. You need those ones who could help source a deal and do significant due diligence on that transaction and structure it. But you also need, to be successful, those individuals who have significant public operating company experience, who can nurture that company, help it grow, and help it make that transition from a private company to a public company. So what we've seen are the more successful platforms, or what we call serial SPACs, have a combination of those type of people. We've also noticed that more private equity firms have gotten into this, and that we are seeing people do deeper due diligence and more of a longer term kind of additive value role. Now, as it comes to building that SPAC, you take a few months before in putting together your team, and then you put together your S1, which is your registration statement. You, with your banks, you file that with the SEC. They take a period of time to review it. And then after they come back and you've addressed their comments, you go public via an IPO with bankers like Nick. And Nick was our banker for New Vista Capital. And we went public for $276 million SPAC in February, around February 16th. So once that you become public and you're now a public company with public board members and you're listed and tradable, you then you have typically 24 months to find a target and to take that target, what we call a de-SPAC, which is essentially a merger acquisition. And then, for example, in our case, New Vista would change its name, and this is in all cases, to the name of the company that it was de-SPACing or taking public via a SPAC. And if you're a serial SPAC, you do that over and over again, rather than just being a one-off platform.
Matt, do you want to take us through the key negotiating issues between a SPAC and a target company?
Sure. And Pillsbury's had a good run in the last couple years on bringing a lot of companies public through the process and handling the de-SPACs on both the SPAC side or the target side, involved in a few at the moment. But I would say the main, you sort of two levels. The first is a point I'd raise, and Chris may be familiar with this, it's kind of the mutual exclusivity side of it. It's the early day thing as you get into the deal, but a real sticking point you have to remember is, SPACs are in this kind of 24-month race to find a target and spend their money. And they're at the current moment, there's nearly over 500 SPACs out there hunting, while there's a lot of targets who are seeing suitors for multiple SPACs. And an early sticking point in the letters of intent is actually mutual exclusivity, and then sort of deciding that you're going to exclude other opportunities and sort of locking in. SPACs is a difference, say, from private equity, who can look at multiple deals at a time. SPACs are kind of get one shot at this, and then they might go and raise a second SPAC or a third SPAC, but it's one. So that mutual exclusivity piece actually becomes very important at the early stages of negotiation. But like most things, as it evolves, it really comes down to the economics. And I think Chris made a good point about how you're bringing together a team with financial expertise and operational expertise, and you're seeing that as a secondary issue to the economic issue, which is who, for the target company, it's who are they getting aligned with? Who is the SPAC? Is this a board? Is this a company that brings some kind of value added to them? What do they know that helps them in a way they couldn't have achieved through a normal fundraising or IPO or round D or something like that? So along the economic side, you really just the core valuation is a big piece of the negotiation. Also, what's the kind of lock-in? How much time does the existing management have to stay invested with and involved in the company post de-SPAC? How much time does the SPAC itself have to spend invested in the company? And is it a quick turnaround, or are they in it for the long haul? What's the management's upside? Control, huge issue. You've seen some SPACs where it's really the SPACs only bringing a minority portion of the company public. I think we're seeing this kind of in the Grab deal that's happening now. And so, what number of board seats does the SPAC get after the transaction's closed? And frankly, one of the things is use of capital. That's where the pipe comes in to some degree. But the SPACs don't want to get involved in this just to pay off somebody else's debt or to pay off somebody's investors. They're really looking at these as growth companies. So there's a real interest in making sure the cash that's going to be injected into these targets is used to grow the company and the valuation and the stock price. So how that's done is a big negotiating point as well. I think those are the main highlights.
Yeah, Matt, to your point, a couple things I would say on that. You raise a good point. So the valuation piece is probably one of the more interesting things, and then I want to pick up on your primary versus secondary. But one of the things that we have struggled with on the advisory side is it's for a company standpoint, right? Who is traditionally let's just say selling their company and walking away. Obviously, those transactions become almost zero-sum games, right? If a company is just being sold from private equity firm to private equity firm, or from founder to strategic, it's every last dollar, and the two sides are very much opposed to each other, and it gets very contentious, right? And the diligence activities, the sellers looking to find ways to get a lower price, and the buyers trying to find ways to push up. That's like the traditional kind of negotiation. This is it's a different situation, and it is hard to reorient your mind, because to your point, the vast majority of the capital that is usually coming into this company is what we would call primary, meaning money going on the balance sheet to fund growth of the company, to fund M&A, deleveraging, whatever it is. It's very much kind of on the company's balance sheet versus buying out the other shareholders. And so the keys is you want access to that capital for all the reasons that we just discussed, and then then ultimately, right, what you want to make sure is that the deal is successful, and that the investors who come in, which is both the investors who backed the SPAC, but also who are investing through the pipe, that they see real upside in their investment. I mean, just fundamentally, why does everyone invest, right? I mean, they invest to make money over time. And so if you push the valuation too high, and this is very much market dependent, and we can talk about that, but if you push the price or the valuation too high, or price it to perfection, you're going to get to the challenge where investors will feel that there's not much left in it for them, or there's more downside than upside, and then you run into a risk on the transaction. So one of the key, just sort of mindsets that you have to understand is when a SPAC and a company come together to ultimately jointly approach the capital markets, public market investors, they need to be realizing that the level of, the certainty of success, and that you want it to trade well over time. Because if you're a founder or a company and you're not selling your shares now, yes, of course, you'd like to print a very big valuation and make all the headlines, because it is a big marketing event, but you want it to do well over time. And if you set it up at the top, there could be a lot of risk to downward pressure. I think that's one point. And then on your secondary piece, that is a thing. You're absolutely right, especially in more challenging markets, which I'd say we're in today. The money going, from public investors to pay out current investors, whether it's the founding team or the venture or the institutional owners, is more challenging than primary. There's just a view on that in the current market, like today, is more challenging for sure.
We have a question from Mike Francis. He's asking, SPACs aren't new. Why do you believe there's been such a rush to utilize that type of investment vehicle as of late? Robin, do you want to take a stab at that?
It's a good question, and look, I'm not sure I'm going to have as thoughtful of an answer maybe some of the other panelists will have. But I think from my perspective, we've seen a number of institutional investors, I think, feeling that they've missed out on some of the early tech companies like, Tesla and others. And as a result, increase the allocation to that type of asset class. So a more high growth, more future revenue. And that created kind of a demand for vehicles to invest in, right? They could have done the venture route, but that is a very different way of investing. And so the SPACs offer them a way to institutional investors, big hedge funds, pension funds, to kind of go out there and invest in this asset class in a more streamlined way. I think that was probably one of the good drivers of my SPAC. And I think the other one is that we are having a number of tech companies out there, not just tech, a lot of it is tech, that just has the need for a bunch of capital to really get to market, and where venture funding, was kind of a longer route, and there was kind of a gap in funding between original venture funding and that growth equity or more institutional later on. So SPAC really bridged that and allowed companies to grow, and I think that's what demand both on the company side, but also on the side. But I would be curious to hear.
Kirsten, do you want to take us through that?
Sure. I would echo Robin's comments. I think that In aerospace, it's following the other sectors. Let's take EV or charging. Both those are highly capital intensive businesses. It does look like there is a trend towards ESG and environmental and climate. So you've got multi-generational trends going on there. And to add to it, they are regulated in their industries. Now, aerospace has followed that. We see some converging of trends in advanced air mobility, whether it's electrification, hydrogen, autonomy, all leading to new types of aircraft. Those are, as Robin put out, they are deep tech, hardware, capital intensive industries, and they're regulated. So those are typically things that venture capital has not historically understood or liked to invest in. And truthfully, we've never really had a robust crossover investment world. So i.e. the groups that do Series C, Series D rounds, we've seen groups float in and out of that in terms of crises, but T. Rowe's, Fidelity's a little bit, but they come in and out and it's not really organized. So what you've seen SPACs come in and do is really step in and be that crossover investor. And then that's an easier way for a T. Rowe, a Fidelity, a Franklin to invest in that round without having to lead it and do all the deep due diligence. So they can diversify and share that risk with other of their public company peers. And this has worked well from a global perspective. It's worked well for companies that are highly regulated. And I think a majority of the investors realize that these are long-term trends and they are still venture to some extent, but that they want that opportunity to get into a Tesla or a SpaceX earlier, given that they missed out on earlier. So, I think many of you know that I was very worried. I often gave, on advanced air mobility, where would the capital come from? And we saw COVID come, the Air Force stepped in and their AFWorks, and that was amazing, especially from the early stage, but those were small grants, SEBR awards. So having this SPAC structure come out and really lean forward and become risk tolerant and understanding has really filled that gap in terms of what we have in the United States. Because what we have in other countries is sovereign wealth fund, and they're able to step in and kind of serve that role. And we've been really lucky that the markets have iterated through and come to this recognition that we're willing to use our capital for earlier stage companies as growth capital.
So, with that answer, would you say it's becoming more difficult to get PIPE investors, or are we still sort of seeing that enthusiasm going through?
I think we can all answer this, but we'll say that there's been a couple things structurally that have happened in the markets which have made type investing more difficult. One is honestly, people have gone back to work, and a lot of these day traders that were around and used some of their stimulus money were actively on Robinhood and enjoying this and kind of stepped away. So you see less kind of exuberance and stocks trading up on news and rumors. The second part is you see the yield curve start to steepen. So in any environment, as we look towards inflation, possibly, whether it's short-term or long-term, and you see the yield curve start to trend up, people start to pull away from technology investments and start to be more thoughtful about, okay, do I need more cyclical investments in traditional rather than the emerging tech? So all of those issues have kind of come together. And the sad part that there's been a lot. So there's been a huge number of companies coming public via SPAC, emerging companies, and there is a limited amount of capital. So I would say those 3 points coming together have really caused a bit of a pullback in the market. Now, this happened in the fall, and Nick will tell you more about this. Some people argue that it'll come back. Other people say this is more of a longer term trend, and truthfully, we don't know. But what I will say is that the market was very hot in the first part of the year, and some cooling off is not a bad thing. We need we want thoughtful, rational investors in this space. We want people making smart deals. That's the way we do it. That's the way we extend this reach in this market, and SPACs are here to stay. So we want smart, good deals. So in some sense, a level of thoughtfulness and rationalness is a good thing. And I'm sure Nick will follow up with my answer.
Yeah, no, you hit almost every point exactly right. There's a lot of technical factors here, and just frankly the timing. Like, keep in mind, if you see it on a chart, just the amount of SPAC IPOs, and then also the number of announced deals that happened in the period from like I don't know, November to February, let's say, of this past year, it was so big. And keep in mind, so what happens, and this is an important point, especially for the pipe market, because that was the initial question. When dollars are committed to a pipe, so let's say a transaction happened in February and an investor committed $20 million into that pipe, whatever. Those dollars then get committed. They are allocated, meaning they're not allowed to invest anywhere else. And those funds get locked up for, what is currently probably 3 to 5 months. And with the current kind of warrant, commentary that came out from the SEC, it could actually take longer. So what happened is so many investor dollars got allocated to deals in that period. We need to let it wave out. So there was a sort of bow wave of deals that happened. And so fundamentally, investors kind of went all in on a lot of deals in a short period of time that have yet to actually be SPAC. So when you see all these deals announced, right, when you've seen, Blade and Archer and Joey, Joey, all these, they're announced, but none of those are actually closed, right? And so all those dollars are still tied up. They're not freely trading. And so, there was just it all got sucked out. And then the other point, and Kirsten said it exactly accurately, was the change in the yield curve. You have to think of the trickle down effect of all that. Because one of the reasons, particularly hedge funds, got so involved in investing in SPAC, particularly the SPAC issuances, not the pipe market. So in her example in New Vista, a lot of those people, you're putting, let's just say $10 a share in, and then you're guaranteed up until the point of a shareholder vote when they find deals, which could be up to 2 years later, you're guaranteed your $10 back plus interest. And when there's no yield anywhere else, you get a chance to put $10 in, earn interest. So let's just say risk-free, right? That money's held in trust. And you're given warrants with some sort of incremental economics, equity upside for that investment. It was a very attractive deal. And then, if interest rates go up, well, then the alternative investments, in other areas, or the safe investments become different. So, there are a lot of technical reasons that happen. 100%, the market is in a worse place than we were in February. I don't think it's necessarily bad. No one knows if it's permanent, but we need to see. There are a lot of SPACs out. I think you referenced, over 500. I think that's right. Over 500 SPACs out there looking to put money to work, and then a lot of announced deals that have yet to actually close. So this all needs to work itself through. And I think investors want to see, some of these SPACs go find deals and see some of these other deals actually close and trade as their own company versus tethered to the SPAC.
Anyone else want to take a stab at that? Matt, do you want to answer that?
Sorry, got to unmute. No, I think all of that sounds about right. I mean, I think, watching to see where I think a lot of people want to see some of these deals close, and I mean, we just anecdotally, it was sort of said, well, if the bank sort of has that money in treasury, they can do the pipe. But if they have got to go out and raise from other sources, then it becomes more and more challenging. And I think that's the other side of it. The mega deal, acquisitions are just getting harder and harder because there's other uses for capital at the moment. But, again, we're also seeing the story change. What are the companies, the targets that are of interest to the market, and where the kind of growth and narrative story is probably a little bit on the downside. And there's a more interest in finding companies that actually have some kind of revenue come up. I think that'll change the pipe story as well as make things that are kind of a bankable company versus there's only so many companies in the make a B2B consumer platform. There's we don't have an actual product yet or sales yet. So I think that'll also start changing the pipe story a fair amount.
We have a question from the audience. Have SPACs overvalued EV tolls and scared investors? Feel free to jump in.
I'll give that. I think that, look, if you look at, let's say, electric vehicles, which you can be compared to, or EV tolls, they're all you can say they're highly valued. And I think it's difficult for people, the uninformed, to differentiate between the companies. So for if I look at the EV companies, I don't have, and I'm talking about electric vehicles, not VTOLs, I don't have a great idea of how to differentiate between who's strong, who's technology, and what's going on. So I would imagine that most laymen have the same issues understanding who is the first to certify, who is the safest, who has the biggest ecosystem, who really is far enough along. So there is a lot of differentiation that has to be done, and a recognition of, it's deep due diligence, truthfully. So I think we are seeing some high values. They are based upon, trading multiples that we see in the tech markets and what you see for Tesla and for some of the mobility companies. And it is a question of whether they can grow into these valuations. Going back to what differentiates each one of them, I think especially the people who are listening to this call typically are more knowledgeable about eVTOLs than the rest of the market. Look deeply at when they're coming to certification and if that is believable. Most of us on this call have lived through other markets, whether it's been delay in Honda Jet's entry into market or other issues with supply chain, the nacelles on Gulfstream. Like, there's a lot of work you need to do to know whether someone is going to be certified. They need to have, a means of certification. They need to have their certifications outline accepted. They need a conforming compliance. They need a conforming vehicle. So dig deep. Those companies that are actually flying true aircraft and have transitioned to vertical flights are the only ones that are any near close in the short term. So again, have they transitioned to vertical flight? When will they get their compliance basis accepted? Those are key questions you all need to ask.
That's great. Nick, do you want to jump in on that?
No, I mean, look, I mean, I can speak from from a technical or market standpoint. I mean, if you, and again, and how much of this is specific to the target companies, but if you look at the trading prices of the, 3 out there that got done, they're all technically trading below $10 a share, which, if you think about what I was saying earlier, where until the moment that those SPACs actually merge into the company, you could conceptually buy those at, less than $10, and then in a couple months when the vote happens, get $10 back plus interest. And so there's a technical kind of mismatch there, like that conceptually shouldn't happen. But by the way, it's happening across not just eVTOL, not even just aerospace, but also just broadly in the SPAC. And it just speaks to some of the, indigestion that the market has in general, just about the number of deals that have gotten done. So, I'm not probably the best to handicap the different companies in vehicles, but I can just speak from a technical standpoint that, right now, they're trading below par, if you will, to use Wall Street parlance.
So, Robin, yeah, sorry, go on.
No, I just to mention, right, I think these are all still pretty early. We talked earlier about, venture capital would usually kind of invest in what such a capital incentive play. And so, historically, early stage companies at that level have a pretty high failure, right? And you kind of could look that up for different industries. But, we would expect, if this wasn't kind of a SPAC situation, that the whole number of these companies would just not get to maturity, right? That's just the reality of startups. And so, the funding will definitely help them scale up quicker, and it will probably help them avoid some early failures. But I think we should still, as an industry, expect that not all of these can be successful. I mean, these are still early stage companies, and there's still a significant risk around, can they actually execute to all the things that Kirsten just mentioned? Is the market really there and ready? And so, I think just because they're public companies now, there's no guarantee that they will be successful in development.
That's awesome. Robin, I was actually just going to follow on from that and ask you what you think all the capital coming into this is going to mean for UAM. What's it going to mean for sort of funding down the ladder, as it were?
Yeah, look, I think, first of all, these deals happening in a way is a great thing for the industry because it raises the profile, right? And every deal that gets done gets a whole bunch of people more educated. You are educating a whole bunch of people through your, which probably wouldn't happen in the same way if we hadn't seen this influx of capital. And so in a way, this funding raises the profile of an industry. And, that brings more people into this industry, it brings more investors in this industry, more companies start taking areas of supply time. we're asking more serious questions. To Kirsten's point earlier, right? We're starting to really pressure test some of these cases because it's becoming much more real. And so that is a helpful thing, not only for the companies who are SPACing, but it's also a helpful thing for the companies who are not going down this. We've seen, a number of VC rounds and private funding rounds recently, both on the eVTOL side, but even more broadly in the ecosystem, whether it's some of the critical suppliers, whether it is, some of the drone space. And, it's helpful that visibility. Now, there's a lot of concern, of course, if you are the CEO or an investor in a smaller company, your competitors have just got a few $1 billion, across them to compete with you, and it raises the question: what are you going to do? Do you stay on the private side, try to kind of clear your path, or do you need to raise capital to, accelerate your path and keep up? And that really depends on the individual companies. But overall, I think it's good for funding across the board, and I think it's good for companies for getting this kind of attention. I mean, I see it on our side. The activity we used to do in this space, even a year ago, very much focused on market size, and finding partnerships. We're now actually shifting to a lot of work and helping people scale up, think about supply chain, think about how to actually build factories and manufacture, and not just with the SPAC companies broadly. And so I think, that really shows that we're getting into a kind of the next level of an industry, away from the concept of much more tangible.
Yeah, and actually, I can jump in here. I mean, I think to zoom out a little bit, this really demonstrates kind of one of the very positive impacts that the SPAC market overall has in catalyzing the adoption of new technology and kind of the future. And if you're, looking at, say, even the Biden-Harris, climate plan and some of their technology advancement plans, the capital for unlocking that, a lot of that all sits in the SPACs. These are the sources of capital that really are going to supercharge technological development on a very company level, and not just kind of these ethereal, let's wait for the government to show up, but big, fire hoses of capital that can go into technology and, capital intensive technology and get them off the ground. And, force in many ways the regulators, whether at the federal or state level, to grapple with these technologies. So, all of a sudden the conversation around eVTOLs is now about, well, what do the cities have to do to make way for these technology? Because clearly those devices are coming. Now somebody's got enough money to build it. So where's it going to land? And I think the city's regulators have to look at that. And so SPACs are doing the same thing on electric vehicles, but not just vehicles, it's accelerating the charging conversation. And it's great that the US government may be putting billions into charging, but you're going to need companies to deploy that and companies to develop those technologies. And SPACs really are providing that capital in a very specific way, but across so many different advanced sectors, that I think when we look back at this, pivotal moment we have as a country and as a global economy, we'll actually look back and see that the SPACs played a huge catalyzing role in unlocking capital to drive these advancements.
Nick, do you want to jump in on that?
No, look, it's exactly as Kirsten said earlier. It's this odd culmination where technical factors in the market, like around interest rates and investment alternatives, and even COVID, kind of happen to marry up, particularly in our industry, but also others, where a lot of these sort of next generation technologies are a heck of a lot closer because of advancements in certain like underlying technologies and just sort of needs. And so it's been really interesting. I mean, on a personal note, Jefferies as a whole, right? Like we're not really involved in the venture capital business. Like it's very rare prior to this whole thing that we get to work with companies at as young of a stage. So it's been really exciting to watch, what the power of the capital markets can do. And I'm very much looking forward to seeing what happens going forward. But, this is the efficiency of capital markets, right? I mean, it just brings tremendous amount of capital, from various sources into, to make these things real. And it's just been a really unique moment in time, and it's allowed kind of Wall Street to play a different role than it traditionally has been able to in these type of companies. So look, I hope it continues, and there's a lot more interesting and innovative companies even within our own sectors that we're talking about here that could certainly benefit from this, and I hope it holds on. Look, the next this summer and fall are going to be really, really interesting periods of time, because we're going to see how a lot of these early deals that we all keep referring to kind of play out, both through their shareholder vote, but then also trading, kind of free from the, the SPAC safety net and all that. And it'll be, I think it'll be really telling to see kind of how this plays out.
Kirsten, is there a fear of a bubble, do you think, with so much? I mean, we're obviously all looking forward to things. So is that a possibility?
I think that fear has dissipated. There was a concern a couple months ago as we were seeing companies that were very, very early stage go public. That is disconcerting because, look, being public is expensive. It's difficult. It's painful. A lot of compliance, and you have quarterly earnings and projections that you have to send to the market. So certainly if you're a pre-revenue company, this is extremely difficult. And certainly if you're years away from certification or entry into service, that is more difficult. So I do think, as a result of what Nick said, a lot of these, certainly in the eVTOL space, trading below face value is a concern. And has put a damper on the valuations that were put out there. This week we've seen the first SPAC company come out and reprice themselves and show a lower valuation. So that is a trend everyone is watching carefully, and could cause other highly valued, maybe overvalued SPAC deals to reprice themselves to encourage investor interest. So again, I think the concern over the bubble has dissipated. It's also the fact that, the change in warrants or how the SEC views warrants has cooled the market as well, which has put a SPAC invest in a space company. There's no way experienced cannabis operators and investors can appropriately and adequately due diligence a space company and the certification risk around validating a space launch. So same thing for these eVTOL companies or advanced air mobility. If you're a generalist SPAC, there's no way you have a deep understanding of how certification works and the risks in the process. What are the risks of going from, you've always done it in thermal set and now you have to go to thermoplastic? That's a huge risk, and a traditional, tech investor isn't going to understand it. So I'm less worried about the bubble these days. I am more worried about that we raise our bar, due diligence matters, and that we have thoughtful investors taking these companies public.
Robin, McKinsey has a great study on the C-suite operators and sort of how that experience. Would you like to add to that?
Yeah, look, I mean, it's a fascinating time, of course, seeing all these SPACs evolve, and we're trying to do research around understanding what the trends are. And unfortunately, this is moving so fast that there's no good solid data of how these SPACs are performing. So we looked a little bit further back, right? Rather than looking at the last 18 months, let's look a few years back, and we kind of, compared performance of SPACs to a whole number of different things, attributes of those SPACs. And interestingly enough, the one thing that really struck out was the operators themselves that started SPACs were much more successful than people who came from other industries, who came out of professional service kind of environments like banking or consulting. And so there's something here in the data, at least, to say that someone who's actually run a company and in the field where the SPAC is, in the end of the day, SPACing, and really understands it, here's the point, ends up having better returns. Now, again, this is kind of correlation in the data. There's pretty lots to unpack here on what the underlying reasons are. But that's one of the interesting things we found in the study, and the full details are available on our website.
That's great. Matt, do you want to answer about the bubble? I think you had some thoughts on that, on the fear of a bubble.
Yeah, absolutely. I think I'm less fearful on the bubble for sure two sides. I mean, the first is, as opposed to an asset class that gets overinflated, this is one of the few investments where there's actually a guaranteed return. Because there's the redemption option before the final deal gets approved, the investors who don't like it can take their money out. So there's a kind of inherent cooling impact that does occur there. But bigger picture, of course, is that we've all seen that the SEC has definitely taken a much more activist look at this marketplace. They've issued these rules around the reclassification on warrants. They've raised the specter of limiting the safe harbor language around future projections. They've, just as a general principle, have explained that they're going to give much more scrutiny to this market, which has had a cooling impact. And the question is whether they're trying to cool it or kill it. I think the read is hopefully cool it and not kill it, because I do believe the SPAC market does actually play a very useful role in the financial marketplace and in economic health of the country. But we're seeing the Congress now looking at it. The House Financial Services Committee is having a hearing on May 24th. Senator Kennedy, the Republican from Louisiana, just introduced a bill looking at the disclosures around in the promoter's economics. So there's definitely that level of scrutiny will cool things down. But again, hopefully it's a cool, not a kill, and will allow the smarter, better, more focused companies with the right attributes to succeed and keep out some of the riffraff that can give this market a bad name. So hopefully, and I think you're starting to see, and just as a law firm that does this, is active in this market as well as in public policy, we're starting to see the industry kind of start figuring out how to talk about this as a unified way, because it's been very fragmented. But now you're seeing this kind of specter from the SEC of threat that industry players are starting to speak up and talk about why this is actually a good thing for the American economy. So hopefully that'll create a new equilibrium. So I don't think we're going to get a bubble, and hopefully we're not going to have a trough either, and just kind of find a nice equilibrium around the SPACs.
Kirsten, there's a question for you from the audience that says, if I heard Kirsten, pre-revenue companies are unlikely to see SPACs looking at them as a target. Do you want to address that?
Sure. I think you will continue to see some pre-revenue companies be SPAC targets, but we do say that they need to be farther along enough so most of the technological risk is behind them. And the way we describe that is that most of the technology risk is back here, and now you've got the commercialization ramp up here. And if you look at an aircraft in certification, maybe you have your conforming prototype, or you've had your means of compliance accepted by the FAA or EASA, and then you're ready to scale and commercialize. So maybe that's a good example of acceptance, that again, you built your product, most of it is done, there's very little risk in front of you. And then what's in front of you is now building up your plants and your training and those type of things, which involves execution. Again, very specific to VTOLs, but that's a good example of where a pre-revenue company might be okay.
That's great, thank you. Let's talk a little bit about the long-lasting effects of the SPAC wave. Anyone, Robin, do you want to take that?
Sure. I think, look, it's an uncertain future, so we don't know, and it can only speculate. But I think there's a few things. I think, for one, public scrutiny of the industry, right? If you have public investments out there and investors making or losing money, that drives, analysts looking at it, that drives regulators look at it. So we'll see, probably more scrutiny than we would have ever thought. The business model out there, and that comes from more media companies. I think that's one of the more lasting. I think the other thing we'll see is that we'll have quicker ramp up. And so there was a question, I think, also around what's the timing, and while I'm not going to speculate on that, having a few $1 billion injected into this industry does make a difference, right? It gives people the money to go certificate vehicles, up their organizations, build networks, find follow-on investments. And so I would expect a longer lasting impact here is a faster scale up of this industry. And that will be good. The companies themselves are going to be successful, not to help develop the industry itself. So those were kind of the two that I would really highlight. Curious to hear what others think.
Kirsten, do you want to long-lasting effects of SPACs?
Look, if we can have pragmatic, judicious, thoughtful SPACs that do significant due diligence, and they can be trusted as sponsors, I think it is great. we need this capital. We need this capital to move the industry forward. And prior to this, the only investors were strategics. Strategics are not, they are good and prudent capital, but they are not great venture capitalists, in which they don't have the ability or the time to sit on boards, to lead your company, and to help nurture a team. And they are good at other things. So the fact that we have some, again, thoughtful strategic investors who can help guide an emerging management team to the next level is valuable and will move our industry forward. We just need it to be prudent, smart, and not have a bubble.
We have another question from the audience. Lots of questions coming in. For retail investors, does it make sense to invest in SPACs before the merger? Upsides and downsides?
Nick hit this earlier. Just a reminder, Nick can follow up. If you invest in a SPAC, at the time of the vote on the SPAC, you get your $10 in interest back if you decide not to go forward with it. So a SPAC at IPO or after is a good investment because the money is held in trust and you can get your $10 back.
And it's the only, if you're from the investor perspective, it lets you participate in the upside of what that empty shell company becomes when they acquire an Archer or something else. And that sort of underscores one of the kind of more interesting facts about SPACs is they're effectively a way for the retail investor to get access to private equity deals. That you used to be that the IPO world was kind of hidden behind a veil, that the big players and the high net worth individuals were the ones who would benefit the most from an IPO. And this actually gives a retail investor that kind of IPO upside that they've never had access, that they've never had before, in a relatively safe way, because as Kristen says, you can get your $10 back or your share back with plus interest if you want to. So we're not. I don't want to be in the position of investment advisor, especially as a lawyer. So not giving financial advice, but for all the reasons we've outlined, it's there is a good amount of upside in there and a fair amount of protection baked in.
That's great. I think we'll have this be the final question. We've got Phil Brockwell wants to know if the panel is willing to make a guess as to when the first commercial eVTOL passenger flight will take place and who will be the OEM of that equipment. I'll let you guys choose how much of that you want to answer. Robin, do you want to begin?
Yeah, look, I'm going to avoid most of it. It's simply because, look, it's a very environment. Here's kind of where I'm in my mind, right? I think we have probably about a dozen who are in a spot where, they could come up with a vehicle, certify it, and start commercial flights, within the next, call it 5 years. I do think all of this will come down to execution. I'm actually less worried at this point about did the vehicle manufacturers pick the right market? Is the design perfect for the market? I think those things will shake out kind of vehicle version 2.0 and 3.0 and kind of as you develop. But to get to market with something initial, I think it really comes less down to did you have the right design, more the right. And I think having a team that knows how to certify an aircraft, we're talking about the large, the credibility with regulators, building a pretty supply chain, that meets the quality of aerospace. Those are some easy things. Given the regular requirements, just take real skill and depth to build this up. So I look at players at my secret quote of them. That's what I really focus on. Who does have a team that can actually.
Nick, do you have a date for when first commercial passenger flight on an eVTOL?
I'm going 2025. That's my
cool. Would you get on it?
That's my line. Yeah, after someone else. Well, yeah, I mean, yeah, probably. No, look, I and what I love the, and Matt, you hit on it earlier, just the collaboration with governments and entities, and not necessarily the I mean, you see, right? You see Singapore, you see the UAE, the Gulf, like a lot of countries like really investing and supporting this. And like that's what you need, right? And that's what's going to make this easier. Because look, aviation for all the right reasons is a very kind of slow, pragmatic, and cautious with safety, safety in mind. But but it also takes the regulatory, getting the airspace right and figuring out. I mean, there's so many logistical things that if you leave that, without sort of a concerted kind of belief and backing of both the regulatory bodies and the governments, and then of course the private entities, that's what needs to happen to make this happen. And I'm encouraged, as cities and countries, try and attack some of their bigger kind of problems, especially as we continue to urbanize, that's what's going to make this happen faster. You want everyone running in the same direction versus opposing forces. And I'm not going to comment on which vehicle I got.
Fair enough. Matt, do you want to tell us which year you think it'll be?
Oh, I have no idea. It's the one area I'm not going to bluff on, but I will say, sitting here in New York City, thinking about the flight I have to take from JFK later today, I was kind of hoping it'd be now. It'd be great if you could advance it just a little bit so I don't have to sit in traffic this afternoon. Would be great.
Absolutely. Kirsten, a year for first flight?
I'm a little more bullish than everyone else, so I'm looking towards late 2023, 2024. And I think, look, one of the great things for all investors out there is you've got some pipe presentations available in the market. So all the guys who've gone public, whether it's Lilium, Archer, or going public by a SPAC or Joby, have their presentations online on their website. Go look at them. They're really informative. And then I would also say that I love eVTOL, the news organization, because they actually give in-depth analysis of what Jay Merkel is saying, what you're seeing Patrick Key saying over at EASA, and listen carefully to how they parse those statements, because those are such indicators of how soon things will get approved and when, and I think they do a great job covering the market. So it's a horse race, but it's going to be exciting and fun.
That's great. Thank you all so very much for joining us today. Thanks for your time. Any closing remarks at all? Does anyone want to sort of leave with a positive note? I think you guys have said a lot.
Well, thanks so much for the time and having us.
That's awesome. Thank you guys. Thanks very much for joining today.
Bye.
We have our Revolution.Aero 2021 global event coming up at the end of June, which you can find your tickets for on our website. Thanks very much for tuning in today. This will be available on on all popular podcasting platforms as well as Crowdcast right after this is finished. Thanks very much, and may the 4th be with you.